Hi there, I'm Joeri Schasfoort from Money and Macro, and it's my honor today to welcome you to this Better Policy Project seminar on the paper Monetary Policy Credibility, Avoiding Dark Corners and Risk Management, a response to Bernanke's review of monetary policy making at the Bank of England, published in the prestigious journal, the Oxford Review of Economic Policy. Today we are joined by Dr. Shalva Mkhatrishvili, who is an economist at the IMF, and by Dr. Doug Laxton, the director of the Better Policy Project. Both are authors of this incredible paper, which emphasizes the need for a scenario-based approach to monetary policy and gives us an example of how such a system can be adopted by central banks while maintaining, this is crucial, their monetary policy credibility and avoiding so-called dark corners, which are extreme economic events. In just a moment, Shalva will present the main insights from this fascinating paper. But first, I want to give the floor to Doug, who will first talk about the model that they used in this paper, which is called the Endogenous Credibility Model, EndoCred for short. Doug, can you maybe tell us a little bit about the model and then specifically the history of this model?
Okay, well, the history actually Mervyn King in a recent conference, I believe at the Ranks said that we need models with endogenous monetary policy credibility. You could look at Better Policy Project website. We have a link that has all the papers that we've used starting in the early 1990s when I was at the Bank of Canada, and we first adopted inflation targeting. We faced this credibility problem. It was a characteristic of all the early inflation targeters that when we announced these targets, they were not believed by the public and by financial markets. And so it took, in the case of Canada, many, many years, like until about the mid 1990s. And it wasn't actually until we balanced the budget in Canada that long-term inflation expectations actually became anchored to the target. And then, of course, we all know about the great moderation. So I've been applying these models in many, many countries that I did technical assistance with that either started off with low credibility and gained it over time and so on. So actually the history of these models goes back decades to the early 1990s and so on. So go to the Better Policy Project website. There's links to it. Now, because of AI, we have actually developed very user-friendly interfaces. These are nonlinear models, and these models can be solved effectively by talking to your iPhone and so on. So I would just like to thank Shalva. We did this work, I believe, over the last year, and after we completed it, Shalva went from the National Bank of Georgia to, I believe, ICD, or Internal Capacity Development, at the IMF. So welcome, Shalva, and thanks, Joeri, for hosting us again.
My pleasure. Okay, Shalva, I believe you have a presentation for us.
Yes, thank you very much, Joeri and Doug, for the kind introduction. So I do have some slides, and we can share them now, and then I'll walk you through the main insights of our paper. And of course, as Doug mentioned, after the central bank, I've joined the IMF, so the usual disclaimer is in order that these are my own views. As for the history of the paper, as Doug mentioned, so it was essentially something that we've been working at the central bank in Georgia and in Armenia as well. We've been doing this work together, and the motivation was that the current approach to communicating monetary policy, so it's a reaction function to the public, may not be as efficient as it could be. And then this work has gone on, and then came Bernanke's review of the monetary policy making at the Bank of England. And if we go to the next slide, we see that the some of the key recommendations that Bernanke had for Bank of England was pretty much in line with what we've been working on at the central banks of Georgia and Armenia. And we came to the understanding that scenario-based approach to monetary policy communication or forward guidance was the way to go because of its numerous benefits that I'll talk about in a bit. And in Bernanke's words, this kind of approach of scenario-based forward guidance or scenario analysis will help the public better understand the reasons for the policy choice, including risk management considerations. And I'll be stressing the last point more in the next slides, so in terms of the risk management considerations. The other recommendation of Bernanke was, if we go to one step further, was to include endogenous responsive monetary policy in the scenarios that the central bank publishes. And this is also a crucial point. This is not something that has been kind of a new. Of course, many central banks, by many I mean a handful of central banks, have been actually following this for several years already, including the National Bank of Georgia, publishing endogenous responsive monetary policy to the assumed kind of inside the scenario that the central bank published. However, as I mentioned, the risk management considerations needs to be stressed, and as we will talk about, this is something that may not be as well captured in the current approach to kind of a standard approach to monetary policy communication or forward guidance as it could be. And on the modeling side, the reason is that the economists may not be paying enough attention to non-linearities that make risk management considerations really important. And an example of this is, as Doug mentioned, if we go to the next slide, a quote from Mervyn King saying that we need models in which credibility is endogenous to its actions, which effectively means that we're talking about nonlinear phenomena, because if whatever central bank does, it doesn't affect just today, it affects the whole future, and potentially in a nonlinear way. If central bank credibility makes inflation too persistent, or as we call it, unanchored, then it can take non-linearly large tightening of monetary policy down the road to bring inflation back to the target, which standard linear models, of course, do not understand, because their credibility is assumed to be always perfect. And the reason why I said that economists may not be paying full attention is, as Doug mentioned, this is this is literature that has been there for a couple of decades, but apparently attention has not been strong enough on this, and that's why one part of our paper was to advertise these endogenous credibility models that we had, and then the other part of the paper is to talk about how we can incorporate these technical tools and the mindset of economists into policymaking and communication of monetary policy. So the next slide shows this kind of example how important this credibility can be. And when I mentioned that if you ease policy more than is expected by the markets, this can have an impact on credibility, and this may generate the need for tight policy down the road to a much bigger extent than standard models would appreciate. And an example is this early 2000s in Israel, when the Bank of Israel reduced policy rate in early 2002, and this was unexpected, apparently something that financial markets didn't expected. As a result, it led to depreciation, which is natural, but the size of depreciation was probably larger than warranted by standard understanding of how monetary policy affects exchange rate. And then our interpretation is that this has to be due to the endogenous nature of credibility, meaning that the central bank lost some part of its credibility that exacerbated the impact on the exchange rate, then on inflation and on inflation expectations down the road. And as you see, the green line here shows the inflation expectations. And to bring inflation expectations back inside the target range or close to the target, it took considerably larger and more persistent episode of monetary policy tightening than you would expect in normal circumstances. And this is a good example that even like a small deviation of the central bank from the expectations of financial markets, if it's perceived as damaging credibility, can have a lasting effects. And this is key. And this is something that our endogenous credibility model incorporates. If we go to the next slide, as Doug mentioned, so this has been a literature going on for a couple of decades, but recently we've put this to the forefront because it became more visible for general kind of audience or economists even. And in addition to this, as I mentioned, we also added to this technical side of the modeling apparatus how we can incorporate the insights from these models and how we can use these models when doing monetary policy communication. So that's our recent paper in Oxford Review of Economic Policy. So the next slide simply explains what are the key modifications in the EndoCred, the model that we call the endogenous credibility model. The key changes relative to standard semi-structural models that many central banks are currently using are a couple of nonlinearities, which is crucial to understand risk management considerations, which communicating of which is a separate issue, and as I mentioned, I'll come to that. But the nonlinearities that we need in the model to understand why risk management considerations are important. One is that we introduce this so-called convexity in the Phillips curve, saying that economic slack may not reduce inflation as much as strong demand increases inflation. So that means that policy trade-offs that the policymakers are facing is kind of asymmetric. If there are negative demand shocks, what we deal with is high unemployment, maybe not much change in inflation. But if demand is too strong relative to potential capacity of the economy, what we're dealing with is high inflation without maybe too much benefit in terms of output gaps. Which means that we are in the middle of a rock and hard place. On the one side, if we generate too much volatility, on the one side we face high unemployment, on the other side we face high inflation. Neither are good. So the average of bad and bad is bad outcome. So that means that good policy on average may not be good enough in terms of macro outcomes. And this is an important feature which generates the need for preemptive monetary policy. But the difficulty with preemptive monetary policy is that you can make mistakes, and that makes these risk management considerations particularly relevant, because now you realize what is more costly error that I can make down the road. I need to follow preemptive monetary policy. That may turn out not to be adequate, exposed, and then the question is what can be more costly? Do I follow too easy policy? Is the cost of too easy policy bigger than following too tight monetary policy? Actually, this is something that the chairman has emphasized in recent, actually a couple of years ago, when the discussion was whether to ease monetary policy rate fast enough. And he explicitly mentioned that easing too soon versus easing too late is the consideration that they are basing their decision on. And that's pretty much risk management consideration. And then that one of the ingredients that generates this kind of makes it explicit, shows the explicit need for these kind of considerations is this convexity in the Phillips curve. And then the main part of the model of the endogenous credibility model is on the next slide, which tries to model inflation expectations in a more realistic manner than standard rational expectations models would show. Namely, what we add are two ingredients. First, we make inflation expectations potentially backward-looking, and whether it becomes backward-looking or not is an endogenous process. Namely, if the central bank has been doing a good job in the past in terms of inflation, keeping inflation close to the target, then inflation expectations remain forward-looking. that makes central bank's job so much easier. But if the central bank has been doing not good enough job in terms of keeping inflation close to the target, either inflation has been too high relative to the target or too low relative to the target, then it damages credibility and it makes inflation more backward looking, essentially inflation becoming more persistent and therefore staying away from the target more persistently. That makes central bank's job more difficult because it would need much stronger policy response to bring inflation to the target because of these higher persistence. So that's one aspect of the endogenous credibility model. The other is we also have these inflation bias terms. When the central bank credibility is damaged, then we see inflation bias in inflation expectations. Either high inflation regime generating positive inflation bias, or we have a negative inflation bias in terms of low inflation regime. And then that's also actually one area that we try to extend because most of the previous endogenous credibility models try to model one of these regimes, like high inflation regime. But we wanted to have both available so that we could understand issues like high inflation, something that was very relevant post-COVID, as well as too low inflation, something that was relevant pre-COVID. And actually, this is something we discuss in the paper. We try to understand the interaction between the decisions of central banks from the US and the Eurozone to understand how each of these economies fared in response to the COVID, initial phase of COVID. And then the next slide. Yes, so before we go to this, just a quick word on why this matters, why having this endogenous credibility can generate unwanted dynamics in the economy. And this means that when credibility is low, not only inflation becomes too persistent and there is an inflation bias term inside the expectations incorporated, but this has, of course, the following implications for the rest of the economy. And one of the implications is that when inflation de-anchors and deviates persistently from target, and that's what financial markets and the public and the economy expects at large, that means that the price level that the central bank is projecting down the road will be so much different relative to inflation going back to the target, or even inflation overshooting or undershooting the target in response to the previous shocks. So this is a nice illustration of how this damaged credibility can affect exchange rate dynamics in response to the same shocks under two different, actually three different cases. If we have a high credibility saying that whenever there is a temporary shock, the central bank commits to not only bringing inflation back to the target, but actually bringing price level back to the pretty kind of a defined path consistent with 2% target. That's so much different relative to case when central bank doesn't have enough credibility to counter the shock, and then the shock results in inflation deviating from the target persistently. That results price level that deviates more and more down the road from the initial expectations. In this example, we have a negative demand shock, essentially leading to lower than target inflation, and persistently so. And that means price level down the road will be much lower than in the case where inflation was at 2% target. And that means if the price level in the very long run is expected to be lower, then the very long run nominal exchange rate also is expected to appreciate, because we know this is essentially purchasing power parity logic. In the very long run, monetary policy doesn't have much effect on real exchange rate, meaning that if price level changes in the long run, so must nominal exchange rate. And that means that if very long run exchange rate is expected to appreciate, then because of this uncovered interest parity condition, then we get appreciation even today. So that's the standard DYP logic. The expectations of exchange rate drives current movements in exchange rate. But if we have appreciation of exchange rate today, in response to deflationary pressures or disinflationary pressures, that makes inflation problem even worse. That hurts credibility even more, and that can amplify this impact on exchange rate even more. So that's the shock amplification via the exchange rate because of low credibility. And then all this is nonlinear. It amplifies, one amplifies the other, and then we have this vicious cycle. And then to demonstrate this, we did some simulations. In the next slide, we have these simulation results showing taking the starting position of COVID, early 2000s, as an initial condition of the two economies. So in the endocred model, we have two economies, the US and Eurozone. And taking this COVID period as an initial condition, what would happen to the exchange rate, to the inflation, to policy rate, as well as to credibility, which is, of course, again, an endogenous part of the story. What would happen to all of this if we just simulate this COVID-like scenario, which initially was aggregate demand declining faster than aggregate supply, and it being kind of in the short run, it being deflationary or disinflationary. So when you face this disinflationary shocks, what you do is you ease policy, hope to see some loosening of financial conditions and helping aggregate demand rise again, as well as having depreciation, helping on inflation on that side as well. But in fact, what happened was that euro appreciated in response to this shock, pretty much in line with what we discussed on the previous slide, and pretty much in line with our endocred simulation. So on the left side, you see the actual exchange rate, euro versus dollar, as well as the model simulation of the exchange rate. And you see that it tracks pretty well the actual dynamics, which shows that one, the model captures this logic well, and then two, understanding this endogenous credibility, the endogenous nature of credibility is key to understanding whether monetary policy credibility is expected to lead to amplification of the shock or absorbing of the shock. And if it leads to amplification, that's an important information for policymakers, because that means that you need to do something else if you are constrained by effective lower bound on interest rates. And that can be either other instruments like a fiscal policy, or at the central bank in Georgia, we actually had the other way around when policy rate was already very high and domestic currency loans were not responding that much, then we used other macroprudential instruments. So that is an important information, because that tells you that if you want to avoid amplification of the shock, you need to do something else if you are constrained by something on one of the policy instruments. So this endogenous nature of credibility becomes important, especially when it matters the most, when we have big shocks and nonlinearities activate. So that's why we think it's very important to have this toolkit, and more importantly, mindset of economists to think about things this way. So the next couple of slides, I want to talk about how we can incorporate this view into our central bank communication, and in particular forward guidance, communicating the future path of policy rate. I've seen and I've heard many times, and many of these cases, even policymakers arguing that communicating future path of policy rate is a non-starter because committees or policymakers can barely agree on decision about the policy rate today, let alone the whole future path of the policy rate in the future. However, even though that argument makes sense, it's difficult to agree on like whole future path of the policy rate in a diverse group of policymakers. Potentially, that argument makes sense, but that's not an argument for forgetting about the future path of the policy rate altogether, because that's always part of monetary policy transmission. Even when central bank just makes a decision about the current policy rate and doesn't say anything at all about the future path of the policy rate, the way current decisions affect the economy is through the expected path of the policy rate. That's always part of the story. That's the channel through which the first first leg of the channel that the central bank hopes to affect the economy. So we cannot really forget about this. Even when we are making decision only about today, the way we are affecting economy is again through expected path of the policy rate. Then it means that not saying anything about the expected path of the policy rate may look like sticking head in sand and hoping that the danger doesn't exist. But of course, it's not a solution. Even though it's difficult to deal with this issue because we cannot have policymakers that fully agree on the future path of the policy rate, we need to deal with this issue. And then question was, is there an approach that can help in this? And then the answer is there is an approach that we try to implement. The Central Bank of Georgia started publishing updated monetary policy report that actually follows this kind of a new approach, as well as Central Bank of Armenia actually fully institutionalized this approach. And I'll talk about this approach in a minute. But this is a response to this real challenge that has been emphasized several times, that communicating future path of the policy rate is potentially a point of disagreement or contention because it's difficult to agree on this. And then we have this scenario-based forward guidance to the rescue, and that I'll talk about this. The other thing is on the next slide, where scenario-based forward guidance helps is communicating the risk management considerations. If we go to the next slide, and a simple example. So imagine what we have, the situation is that the most likely outcome, or more technically the mode of the inflation forecast distribution, the most likely outcome shows that inflation remains at the target. But imagine the risks are asymmetric. There is a higher risk that inflation will be higher than this target, then it will be lower than the target. Even though the mode of the forecast distribution or the most likely outcome says that inflation remains close to the target, it doesn't mean that the optimal policy is to do nothing. And if we go one arrow down and then add the policy choices, so what would baseline-centric approach or baseline-centric forward guidance would suggest? It would suggest that keep policy rate unchanged because the most likely outcome is that inflation remains close to the target, so no need for response. But as I mentioned, this may not be the optimal outcome. For instance, if you look at the literature on robust control, you ask a question of what is the potential cost that my decision today can result in down the road. And then here, when the distribution is asymmetric, then this cost can be very high. If for some reason inflation turns out to be very high, because the probability is higher than inflation being low, then it can generate a very big cost for the central bank, exactly because endogenous credibility, inflation becoming persistent, inflation bias term appearing, requiring stronger and much tighter policy down the road that can be very costly for output. So that means that the optimal policy may be to somehow ensure against this bad outcome, or what we call dark corners, a la Blanchard. Then following this approach means that we may look like we are following policy that is tighter, overly tight, relative to what's warranted by the baseline, the most likely outcome, but it's still optimal. So if you go one arrow down, we have this risk management approach to monetary policy, or what we call FPAS Mark II, Forecasting and Policy Analysis System Mark II, the next kind of a generation of approach how to do forward guidance using this system. So we essentially tighten monetary policy today to ensure against particularly bad outcome at the marginal cost of undershooting inflation target in the most likely scenario. So that cost may be benign enough to pay for ensuring these nasty nonlinearities and dark corners down the road. Communicating this is very difficult if you have only baseline scenario and baseline centering forward guidance. But on the other hand, if you follow the scenario-based forward guidance, you can communicate this much more easily. Make a decision that seemingly seems inconsistent with your most likely outcome, but it still makes sense. You can still explain it to the public. And even more, when you have risk management considerations and communicating your reaction function becomes so much difficult because that means your reaction function is nonlinear, then using this scenario-based forward guidance can even ease these tensions of understanding what the central bank does, what is its reaction function. So if you go to the next slide, so this is something that at the National Bank of Georgia we faced ourselves after COVID, right after first phases of COVID in early 2021, we actually realized that COVID is also a big supply shock, and this can lead to higher inflation down the road. Of course, we didn't realize that inflation would be as strong as it was actually, but still the bias was policy bias was towards tightening because of potential acceleration in inflation. And the reason why we placed emphasis on that was exactly because in the past inflation for a couple of years was already above the target, and meaning that this endogenous nature of credibility was in our minds. And for that reason, we started to communicate this alternative scenario in addition to the baseline one, saying that there is a risk that inflation can accelerate and require much tighter policy. And by the way, we also published, and we keep publishing it, the policy rate trajectory in all of the scenarios, including this alternative one that you see on the slides. And as you see, policy rate tightening much faster than the baseline scenario would suggest was something that we did communicate. But because, again, the communication was mostly baseline centric, or at least that's how the financial markets perceived it, the market was sluggish to respond, to understand this message. And therefore, we needed to tighten monetary policy further and then have it maintained longer than maybe we could have we would have needed if the tightening was transmitted to the financial markets early on. That means that this is something that was already on the minds of the staff as well as policymakers, something that we wanted to communicate, but maybe there was a better way to do this, and a better way, I would argue, is this explicit emphasis on scenario-based forward guidance. And what we mean by this is on the next slide. We also discussed this within our paper and apply this to the case of the US. So how do we do scenario-based forward guidance? So everything starts from the market consensus, which is essentially what the financial markets are expecting about the policy rate. Extracting this information from financial markets is, of course, very easy from well-developed financial systems like in the US or in Eurozone. But of course, for countries like Georgia and Armenia, we had to come up with some other approaches and methods as well to extract this information, or even rely on surveys of professional forecasters. But in any case, the starting point is what is the financial market really expecting? Because as I mentioned initially on this part of the slides, expected path of the policy rate is the cornerstone of how monetary policy affects the economy. Therefore, we need to understand what is the expected path of the policy rate, at least the best we can do. Once you have this market consensus or market expectations, then you discuss what are the best arguments to have a policy that is above the consensus or case A, and what is the best argument for having policy rate below market consensus or case B. So tighter than market and then easier than market. What are the best arguments for this? And which argument is more relevant for policymakers can be important for decision. And again, this goes back to this point of either asymmetry in the forecast distribution or asymmetry in policymakers' risk tolerance. if policymakers think that case A scenario is more relevant, not because it's more likely, but because it's more relevant in a sense that it's costlier and we want to insure against this outcome more, then central bank may make a decision that is tighter than the current market consensus. So if you go to the next slide, that helps in kind of a, if you go one arrow down, that kind of approach helps to strategically nudge market expectations, essentially saying that one of the risks is more relevant today, again, potentially not because it's more likely, but because it's more riskier, because of nonlinearities. Actually, we can sometimes have other additional scenarios like what we call case X, which is like where nonlinearities kick in a full-fledged manner. But if this scenario is more relevant for policymakers, then they could explain that this is something that's more relevant, and therefore my decision is deviating from market expectations in this direction. And when this is explicit, then you essentially provide the market guidance in which direction to adjust their expectations of the policy rate. So this is what we would call like a strategic market nudging. But the benefit of doing this strategic market nudging this way is that it still gives central bank this flexibility and agility. That may be a challenge in baseline-centric forward guidance because, as we mentioned, many policymakers were kind of worried that they cannot agree the most likely future path of the policy rate because they may have different views. And therefore, instead of kind of committing to some path of the policy rate down the road, that could be kind of a concern for policymakers, and that could be a reason why they avoid communicating or publishing policy rate paths within the baseline scenario. Well, that disappears here. We don't have that concern, and then we could have policymakers retain flexibility and agility in response to new shocks, but still continue this strategic market nudging, affecting expectations of the policy rate, which is again the first leg of the policy transmission. So that means that we achieve the same outcome that we may wanted to achieve with this baseline centering forward guidance, namely affecting the expectations of the policy rate, but with less concern on the commitment kind of considerations and retaining the flexibility. The other benefit of such a forward guidance, scenario-based forward guidance, is if we go one arrow down, is better communication of reaction function. If you go one slide down, so the communication of reaction function, as I mentioned, we could say that it could also be done within a baseline scenario centric forward guidance, but that may not be as well communicated as within the scenario-based forward guidance, because here you provide a menu of different and currently most relevant cases in which you tell the market how you expect to react to these outcomes. So that's also somehow this communication of reaction function being more explicit and useful information for the financial markets. Again, especially when you have the economy that is sometimes prone to nonlinearities, and when you have nonlinearities, communicating reaction function with simple equation like, for instance, Taylor rule is not really possible. So you have a much more complicated reaction function than can be summarized by a simple equation. And what's better way to summarize this reaction function that's complicated in a simple way than to just tell the market that this is how I would react in case A versus how I would react in case B. And again, this case A and case B scenarios can change down the road depending on what becomes relevant during that policy round. But the most important benefit of this is these risk management considerations and making communication of that explicit. Why? Because if you have the scenario-based forward guidance, you can actually tell the market that this is a scenario that's frightening for me, not because I expect it to happen, but because it's very costly, and I want to insure against this, so I nudge financial markets in that direction because I want to insure against this risk. And this is very difficult in a baseline-centric forward guidance. If we just forget about economics, for political economy considerations, I'm kind of convinced that communicating and mentioning that there's a high inflation risk or too low inflation risk in the baseline scenario is something that many policymakers would avoid. They don't want to essentially create expectations, self-fulfilling expectations that would complicate central bank's jobs itself. So if you expect, if you think that there are risks on the higher side for inflation, like there's high inflation risk, if you say that I expect inflation to be high and financial markets and the economy believes you, then inflation expectations really increases, and then you need to tighten not only by the amount that you were kind of expecting, but even more. So you're doing you're not doing yourself a favor if you do such a thing, and that means that policymakers may always try to downplay risks if they are forced to communicate policy within a baseline scenario. And this is not necessarily true in case of scenario-based forward guidance. Here you can be explicit that it's one thing what's most likely outcome, but it's another thing what I'm reacting to. I'm reacting to risks potentially unlikely, and then in most of the cases unlikely risks, but risks nonetheless. The risks that can be very costly, and then I want to insure against those outcomes. So that is easier within the baseline, this scenario-based forward guidance. And again, this all squares with this mindset of endogenous policy credibility, nonlinearities, and therefore understanding how to communicate and how to do actually risk management consideration within monetary policy. So let me stop here. This is all I wanted to cover. Thank you again, and I'm looking forward to the comments and discussion.
Right, Shalva. Thank you so much. That was very interesting, I think, especially for central bankers who are watching. Now, my question to you is, if I was a central banker watching this, of course your presentation was quite dense, if I may say so, in a good way. But some takeaways that I would have that are indeed very different from if you look at traditional economics would be, okay, so actually, especially for emerging market central banks that are often more conservative, it may make sense that may actually be optimal because they have higher risks of facing these dark corners, especially if they have a small currency. So they could potentially use these models to justify what they were already doing, right? Is that a fair way to look at it?
I think that's fair to say in some of the cases. That's certainly fair to say about the NBG because, as I mentioned, we kind of were trying to pay attention to risks that may not have been the most likely at that time, obviously. For instance, in early 2021, we didn't think that inflation being very high down the road was the most likely outcome, but we still paid attention to this scenario. But the communication side maybe would have kind of helped to have this more explicit emphasis on scenario-based forward guidance. That's my view. And so that means that that actually, this is a framework that may help central banks that have been doing this within the current framework, but make it more explicit. But for some other countries, maybe it could be a cautionary tale or kind of a message that if you're not paying that much attention to risks or tails of the distribution or the dark corners, then it might be kind of prudent to pay attention to this. That's actually what we call it, a prudent risk management approach to monetary policy.
Yeah. No, I'm especially thinking, for example, I just think it helps to I will give you some examples also, which may help bring this topic to life a little bit more. For example, when I was in South Africa, I remember the Reserve Bank there being often criticized by politicians or commentators for being too conservative for not allowing the economy to grow too much. But they didn't have the language to communicate then, well, we're doing this from a risk management perspective. And this sort of validates their position, right?
Yeah, absolutely.
And then a second maybe interesting example is then Argentina. You now have, of course, Milei in Argentina, who's not a central banker, but still in control of fiscal policy. And this also sort of seems to justify a very relatively harsh and ultra-conservative approach initially for maybe 1, 2, 3, 4, 5, 6, 7 years in a case like Argentina where credibility has just completely been lost, because then inflation expectations are backward-looking, if your model is correct, right? And they're also biased towards high inflation. And so the only real thing that they can do is to be more conservative than a standard model would prescribe, right?
Yeah, that's a very good point. To be honest, I haven't thought about these kind of scenario-based forward guidance and risk management considerations. How can it be applied to fiscal policy? But I think that's a very good example.
And then finally, I just wanted to ask you about your point about forward guidance. You mentioned that by communicating these scenarios, you actually improve forward guidance. Because you may avoid sort of self-reinforcing expectations by giving a baseline scenario that is too alarming, for example, right? So the point then that giving more this way, what you're actually doing is giving more realistic information on your thought process to the market. So you're just giving them more information, more higher quality information, and hence you expect a better outcome from financial markets. Should I look at it like that, or is it more nuanced than that?
Yeah, I agree, exactly. So one benefit of it is exactly that you are giving better information to the financial market, because there is less incentive to downplay risks. For instance, if imagine you are a central banker and you face COVID inflation, and saying that inflation will be persistent, that's tough. You cannot really do this because, one, you are not sure whether it will be persistent. But even if you think that inflation being persistent is important enough risk to take into consideration, you may not be able to say that this is the most likely outcome. Instead, you may be incentivized to say that inflation will be transitory. That's what almost all of the central banks did. But if you have the approach that gives you flexibility of saying about risks, because it makes it explicit that this risk is not something that we expect in the most likely scenario, but it's something that's important enough to pay attention to insure against, then it makes it reduces the incentive to downplay risk, and therefore makes policy freer or more responsive to such risky outcomes. And then that's helpful for central bank kind of a response. And also the other benefit is that if you have scenario-based forward guidance, you don't need central bank policymakers. That can be like a diverse group of policymakers. Some of them can be more kind of dovish, others may be more hawkish. They don't have to agree on one single line of policy rate down the road, which is almost impossible. Unless there is some special kind of a setup of central bank governors. In this scenario-based forward guidance, you have these different plausible risks on the upside, on the downside, and it can still be communicated to the public without saying that this is our commitment to such a path for policy rate.
Yeah, and then the one thing in presentation that I struggle with a bit, and I think if I struggled with it, a lot of people listening potentially also did, was the relationship between interest rates and the exchange rate. So, okay, I followed your reasoning where you said, look, if the interest rate doesn't respond to inflation correctly, then you lose credibility, and then you will have to overcompensate later on to restore credibility. That makes total sense. But then how does that interact with the exchange rate? Can you maybe go over that again?
Sure. You're absolutely right. If you cannot respond to inflation, that exacerbates the inflation problem, and exchange rate is one of the channels it does so. Namely, for instance, if you have this was an example in the paper. Assume we are in the early phases of COVID hit, and demand declined more than supply, meaning that in 2020 we had kind of a disinflationary or deflationary forces. And what you do when you face deflationary forces, you have to ease your policy. But if you are constrained by the effective lower bound on your interest rate, then you cannot ease. And if you don't do anything else, then inflation decline becomes more persistent. And when inflation declines more persistently, it means that price level down the road will not increase as much as it was expected to before the shock. And if price level is not expected to increase in the future as much as expected, that means that nominal exchange rate in the very long run needs to appreciate to keep the international kind of economic kind of forces in equilibrium. And then this argument is essentially purchasing power parity, saying that in the very long run, one country's exchange rate against the other country's exchange rate should be close to, sometimes they call it fair valuation, essentially saying that they shouldn't be either too competitive in terms of like a depreciated exchange rate or too expensive in terms of overly appreciated exchange rate. That's the purchasing power parity argument. And that argument tells you that if you have a price level low, your exchange rate needs to be appreciated as well, because low price level gives you competitive edge against your trading partners, but appreciated exchange rate then counterbalances this so that you remain in equilibrium. And that's kind of pretty much the argument about the exchange rate. And if you expect in the very long run that an exchange rate will be appreciated, then that expectations have an impact on current exchange rate as well. If you are a financial market player, so if you think that down the road the exchange rate would appreciate, the euro would appreciate, what you do today is you increase your exposure to euro assets. You long euro, buy euro, and wait for the appreciation. But if you buy euros, then it contributes to appreciation even today. And that appreciation in response to deflationary forces makes these deflationary forces even worse. So that's the shock amplification working via the exchange rate.
All right. Thank you so much. Are there any questions also from people in the audience still?
Well, I have a couple of comments. First one, Joeri, in response to your last question, if you compare Japan with seasoned inflation targeters like Canada, for example, and you think about when the global financial crisis started, first hit in 2008, the Bank of Canada had a lot of interest rate space, and they were expected to cut rates to the effective lower bound very quickly. But the Bank of Japan had very little space, and so the Japanese yen appreciated, and that exacerbated the effect on their economy enormously. Like exports fell drastically, domestic demand fell drastically, and they actually had an output gap that was much larger than in Canada. Okay, so that's a really good example where two countries, one that is a seasoned inflation targeter, gets these stabilizing forces from exchange rate dynamics, and another one like Japan, where they don't have very much space. But it's even worse than that, because if you look at really high frequency data, when Japan was at the effective lower bound, for Canada, a seasoned inflation targeter, on days when there would be bad economic news, you'd have market commentators say, well, there was bad economic news in Canada, So therefore, the Toronto Stock Exchange fell and the Canadian dollar depreciated. For Japan, you would have the exact opposite when they were at the effective lower bound. You would have exactly the story that Shalva is talking about. You would have a story that there's bad economic news, the Nikkei would fall, and the Japanese yen would appreciate. So these amplification effects are very real, both in extreme situations where a country it has very little policy space versus a seasoned inflation targeter. So I just wanted to talk about that. Second, there's a book by Maury Opsfeld and Tobias Adrian that we published in 2008 that took stock of the experiences of what we call FPAS Mark 1, or inflation forecast targeting, where the baseline is very, very important. And what we found is that they did much better than central banks that said nothing. So they anchored inflation expectations much better, and of course they had this stabilizing effect on real interest rates and real exchange rates. Just to comment about what's wrong with FPAS Mark 1 and too much emphasis on the baseline. They actually started publishing the path of the policy rate in New Zealand in the late 1990s, so they've been doing it forever. But at the time, they had a governor decision-maker framework, so it was much easier when you only obviously have the governor that effectively is delegating all the technical things. The other really good example of FPAS Mark 1 was the Czech National Bank, and they had a board. But the problem is that when you are doing this FPAS Mark 1 framework, the board had to rely extremely heavily on the staff for producing that baseline forecast and so on. And I think one way to think about FPAS Mark 2 is that it's opening up discussions among the board, giving the board members much more of a role, where instead of just buying one scenario from the staff, because obviously a board can't, it's impossible, as Shalva was saying, for the board to actually construct that line and stuff. You need to have professional staff doing it. Now, the way the Czech National Bank did it is they would talk about that baseline forecast as a frame of reference, and the board would say, we're not committed to that baseline line. It's just a baseline that's been provided by the staff, and we use it to discuss monetary policy in reference to that line. But if you think of actually, the line as being something that the central bank is actually committed to it, you can see that there's big problems, because it takes time to construct a consistent baseline forecast. So, if something happened a day or before, or a couple of days before you were about to make the decision, if something big happened, it'd be impossible to construct that line. And so FPAS Mark 2, you might say, is much more feasible. And actually, the Central Bank of Armenia is about to launch a book that describes all aspects of FPAS Mark 2, and one of the main points is that it opens up communications across the board members. There's an incentive not to agree on one line, but to include everybody's views about the potential risk. The other point I would make about FPAS Mark 2 is that, and this is related to what I do, it's much easier to train the staff on something that makes sense. And the problem with FPAS Mark 1 is it was very problematic. As I said, if something happened just before the policy decision, it's impossible to redraw the line in a sensible way. That it takes the staff time to impose a macroeconomic consistency on it. So we actually have the draft of the Central Bank of Armenia book on the Better Policy Project website that you can find, and it describes all aspects of FPAS Mark II, not just the policy aspects, but the effect that it's had on raising human capital inside the central bank, which I think is is something that people need to look at.
Right, Doug. Thank you so much for these clarifications. The Japan example was especially helpful. So thank you so much, and I'm sure that if you're watching this on YouTube, the relevant paper and books and Better Policy Project website will be linked in the description. So thank you both for coming on.
Thanks, Joeri. Thanks, Shalva.
Thank you very much for having me.